समुद्र को आने दो या नदी को आने दो, फिर हम सोचेंगे कि whether that is a breeze or we have to swim. आया ही नहीं अभी. So you should not think about those things. When those things comes, what will be your course of action? That is different. Okay. So for example, I have given that. So do not take it granted that these are the always which is happening. Everything in banking business is totally changeable. Today rate of interest is 6%, tomorrow it might be 5.75. So still people keep the money in you, na?
Yes, sir.
So a public sector bank is more reliable than a mutual fund. Suppose I have 100 rupees surplus money. I will try to keep 60 rupees in a public sector bank, 40 rupees in mutual fund or share market. I will not keep 100 rupees in mutual fund and share market because I know that this is a risky. This is less risky or risk free. So I can say that I can keep more, or I can say 50-50. I can share it 50-50. Some part I want my money to be secure. So rather than putting in the risky business, I will put in some risk-free or zero risk. That's why bank FD, government bond, they are. Do you think government fails? Government will fail. Have you encountered any public sector bank has failed totally, for which DICC has given 5 lakh to each and every customer? Can you see for the last 100 years, any private sector bank has been closed and the public sector bank has been closed, and DICC has given 5 lakh to a person who has kept 50 crore? Can you give me any example?
No, sir.
No, sir.
So why this question comes? It has not happened. It will not happen because there is a backing of government behind public sector bank. Government will not make it happen that public's faith will go. So such things will not happen. So that's why we are talking about risk-free public sector government. When it is private sector, then this is a private sector bank, it might happen. In that case, we have nothing. So you are taking a risk. You are keeping your money to get higher return. So when it is a higher loss, you have to suffer it. So there is no way out. Okay. So such questions are not warranted at all. You should not bother about such questions. Now I can give you simple example about, suppose there are two investments. These are all hypothetical example I am giving to make you understand about risk management. Do not take it granted that these things are going to happen in bank or anywhere. Okay, these are for example to make you understand about passing CIP only. So somebody has offered you, some financial institution offered you two investments, investment 1 and investment 2. You are the investor. Investment 1 says that every year you are receiving 10,000, 10,000, 10,000 for 5 years. Total 50,000 you are receiving at the end of 50th year, along with your principal, whatever you have invested. Second investment shows that your inflow are varying. It is not a constant like 10, 10, 10 every year. So first year 9, second year 10, third year 13, fourth year you are not receiving anything because that is negative. Fifth year it is 21 as high as possible. But both the investment results are 50,000, 50,000 at the end of 50th year. So if these two investments choice are given to you as a simple normal human being, which one will you prefer to invest your money?
First one.
So 99.9% people will choose investment 1 because they, although these are two are same, why should I invest in investment 2? Because every year I am getting 10,000. That is very helpful for me. Why should I get 9,000 some year, 10,000 some year? Fourth year I'll not get anything, but lastly I'll get 21,000. But I need a constant cash flow or continuous cash flow each year. So investment 1 is preferable to me than investment 2. So when you are taking a decision from the return point of view, although both are yielding the same amount of return after 5 years, however, one is more likely to prefer the investment one than investment two. This is because there is a steady stream of cash flow or cash inflow associated with the investment one. And for investment two, that it's not steady. Simple. Is it understandable now? Okay. Now I will give you a third type of investment. Suppose now we are given it a three type of investment, where investment three, this investment three is resulting in slightly more return, which is more than these two. So here there is a extra 4,000 rupees. Now it is given by the same bank, same financial institution, which is investment three. Now can you tell me how many of you will try to shift from investment one to investment three?
Yeah, I prefer investment three.
So basically, normal psychology is that we know that there is a higher return, though the cash flows are not steady, but still, since the return is more, so you can say that I will prefer investment three. So maybe 60 to 70% people, 60 to 70% people out of 100, they will prefer this one. But some certain people are very traditional. They will say, "Nahi baba, theek hai. This constant thing is good for me. I will still continue with this one. I don't want to take risk because I do not know whether this 50 or 54 all are totally unpredictable." As somebody tells, in between the bank or the financial institution collapses, so you will not get anything. Everywhere there is a risk. So investment three would be preferred or acceptable, provided for the fact that there is a higher return associated with it. If it is not higher, then definitely people will not attracted to investment three. So we can say that here, suppose 10% was the return, here return is 10.8%. So this difference of 0.8% is nothing but called the risk premium, because this is little bit higher risk investment where the premium is more or return is more. So this extra 0.8% is called a risk premium, or we can call it as the cost of risk. This is the cost of risk, because you are taking a risk on investing this in a riskier measure. So the cost of risk will be paid to you back. So that's why it is called higher the risk, higher will be the return, or higher will be the premium. Simple thing. Unless this risk premium is not given to you, people will not be investing in such investment. They are not interested because they are looking at the return. So return is the main concern. That is called risk. So what is risk premium? So that additional return which you get from any investment is the risk premium, or it is also called cost of risk. Clear? So last one for today's thing. So we have from the morning 5:30 onwards, we have encountered these three terms: risk, capital, and return. And we are talking about the bank or financial business. So we understood what is the risk. Why risk is important? Because we have to strengthen the capital. Because we need a robust capital to save us from bankruptcy. And we are in the business to get a return. So these three things are interrelated. So there is a linkage between risk, capital, and return. So that is the basis of this risk management. So as I told you, we have understood that for high risk business, higher capital, low risk business, lower capital. Now, every bank is doing the mixture of high risk and low risk business. So to how to come with a standard or benchmark type of capital. So that capital is called minimum capital requirement or minimum capital required, MCR. Because you are venturing into different kind of businesses. You are doing credit card, you are doing housing loan. So there is high risk business, there is low risk business. So to come to an average, all the things should be made in such a way that you need a minimum capital to sustain the banking business. So that minimum capital requirement has to be calculated. So that is for a, what is that capital? That capital is the amount which is able to, if you maintain that, you will be able to meet the maximum loss that may arise from the business which would avoid bankruptcy. So doing your business every year, so what is the minimum capital required to be maintained by you? That amount, say X amount you want to maintain, and that amount will be able to compensate or absorb the maximum loss that might happen during the year so that you can avoid the bankruptcy. So that capital is called minimum capital required. Okay. Now, capital requirement for high risk business would be higher, already we have explained, and low risk will be lower. This is the basic linkage between risk and capital. So risk and capital relation is that higher risk, you have to maintain higher capital, lower risk, lower capital. That is the linkage between risk and capital. Okay. Now, as regards return or profit and loss, high risk business may give you higher profit or higher losses. Low risk business will give you lower profit or lower losses. So that is the linkage between risk and return. So you have to see the linkage between risk and capital and risk and return and say that this is what is the basis of risk management. And when the risk in a business, there is a risk in each business of banking. So when that risk in the business or our investment in that business is netted against the return from it, then it is called risk-adjusted return on the investment or risk-adjusted return on the capital. I'll just make you explain. This is very important. RAROC or RAROI. Risk-adjusted return on the capital or risk-adjusted return on the investment, both are the same thing. Because we are investing in the capital or investing in the fund of, we get it from public as lending and investment. Okay. So what is that? So when the return, we have read that in the return, when you adjust that risk, when you adjust the risk amount from the return you are getting, when this adjustment takes place, the final result is the RAROC or RAROI. So you know there is some risk, so you can quantify that risk, how much risk it is there, and how much return you are receiving from that investment. So say you have invested as a banker, you are lending something. Say in that loan, you have, so your earning is say 10%. Say 10 rupees you are earning. So that is your return. And you know that there is a risk in that particular loan, there is a risk for which I have to carry the capital as 2 rupee. This is just example I am giving. Okay. So 10 rupees was the return from that loan. This is the return. And for that return, in that loan, there is a risk for which you have to maintain a capital, which is the risk factor. So you have to maintain the 2 rupees as capital. So this is a capital you have to set aside. So for 10 rupees return, you have to set aside 2 rupees as a capital. So resultant is 8 rupees. This 8 rupees is your risk adjusted return on the capital or risk adjusted return on your investment. And 2 rupees your risk factor, that is the risk amount or cost of risk for the loan you are giving.
Sir, how to
So
calculate that risk factor 2 rupees? How to quantify that?
So that we will learn afterwards. When we calculate the amount of capital, that is the amount to be deducted from the return. So that then only we have RA, ROC or adjusted return on our capital or investment. So there are so many statistical methods which are not in our syllabus of CIB, BFM. So there are specific way of calculation how to calculate. Just for example, I am given. There is certain risk for which we have to factorize the risk, how much risk it is. So we quantify it. So in this example, I have quantified the return as 10. I have quantified the risk as 2. So when we take out that risk from the return, whatever is left over, that 8 rupees is called RA, ROC or RA, ROI. Certain formulas are there. I will let you know how to calculate by applying those formula. Those can be calculated. What is RA, ROC for this? So it can be calculated. Okay. So any other question? Otherwise, we'll today we'll complete this session. Any question is there? You can ask me right now. If there is no question, then we can say a good day.
So that means we have to maintain 8 as capital to mitigate our risk. No, the last question that we have discussed.
Yes. What is your question? Tell me again.
I want to say, like, as we have find out, no, 10 minus 2, 10 is our profit and capital, and 2 is our risk.
No, 10 is your return. 10 is your return.
Return, yes. 10 is our
2
return,
rupees,
and
2 rupees is the
8.
cost of risk. 2 rupees is cost of risk. Yes.
Yes.
Okay.
So 8 is our capital that we have to maintain to mitigate the risk.
No, 8 rupees is your final profit in your pocket. Risk adjusted return. That is you cannot say that 10% you are charged.
Profit minus
capital.
Okay, profit minus risk is our net risk adjusted
yes,
return.
Yes.
Okay.
Suppose you are charging 10% interest for a loan, you cannot say that 10 is my return.
Okay.
Right? Because there is a risk involved, you have to minus that risk. So 100 rupees loan you given, 10% interest you are charging, you cannot say that 10 rupees is my final income. No, your income is, total income will be 10 rupees total return minus the risk in the business 2 rupees. So 8 rupees your final return in your pocket. So that return is called risk adjusted return on your investment or capital. Clear?
Okay, sir. Clear, sir.
Sir, that 2 rupees, it may be a NPA provision, you know, sir.
Why this NPA provision? It might be anything. So you have bought a scooter or motorcycle. So you are buying a helmet. So helmet is a cost of risk or not? Yes or no? You extra you are buying, na? So there are different type of